Welcome guys to a new video. Fascinating to see how traders who are clearly among the best in the world often post dismal win percentages, yet still turn a profit. On the surface, it seems paradoxical. How can someone boast an 80% losing rate and still make money? It appears contradictory. Can someone please shed light on this phenomenon? Well, I'm happy to explain this apparent contradiction. It's actually a well-known principle in the trading community, but somehow this basic concept often gets lost in the shuffle. So here's the secret. In essence, a trader doesn't need to have a high win rate to be profitable. All that matters is whether their system has a positive mathematical expectancy. Let me illustrate this with a simple example. Suppose a trader wins 40% of the time, but here's the catch. When they win big. Their average win is 3 times larger than their average loss. When they lose small. What's interesting is that even with such a modest 40% win rate, this trader ends up making more money than someone who wins 80% of the time, but only wins very small amounts on those trades. Think it sounds too good to be true? Well, let's test this out with some numbers. Using the formula for mathematical expectancy, we get 0.4, 3, 0.6, 1, 0.6. Now anyone can see that the expectancy is positive, which means this strategy is likely to be profitable in the long run. What's happening here may seem counterintuitive, but it's entirely logical. To grasp this concept, we need to shift our perspective. A high win rate alone doesn't guarantee profit. In fact, the absolute value of the win rate is irrelevant. What truly matters is the amount won and the amount lost. To simplify things, let's stick to a risk-reward ratio of 1:1. When a trader's stop loss is the same size as their potential profit target, we call this a 1.1 ratio. In this scenario, the trader needs to win 50% of the time to break even. If they win more than 50%, they'll be profitable. For instance, if they win 55% of the time, their profit will equal 5%. If they win 60% of the time, their profit will be 10%, and so on. However, if a trader has a negative expectancy, meaning the losses outweigh the profits, then every percentage point above 50% win rate reduces the loss, bringing them closer to break even. The crucial question is this: does this concept still hold true when the risk-reward ratio deviates from 1:1? The answer is yes. Let's look at a more realistic risk-reward ratio, say 1.2 or 1.3, or to keep things simple, 2.1 or 3.1. In this case, the trader would need to win only 33% of the time to break even. If they win 35% of the time, their profit would be 10%. With 40% wins, their profit would be 20%, and with 45% wins, their profit would be 30%, and so on. The same principle applies if the risk-reward ratio is 3:1. The trader would need to win only 25% of the time to break even. At 27%, their profit would be 10%. At 30%, their profit would be 20%, and at 33%, their profit would be 30%, and so on. When the risk-reward ratio is greater than 1.1, a trader can turn a profit with a win rate lower than 50%. This is the secret to creating a profitable trading system. You don't need a high win rate. What really matters is having a favorable risk-reward ratio and a positive mathematical expectancy. In reality, you won't always have perfect risk-reward ratios of 1.2 or 1.3. Most of the time it'll be somewhere between 1.1 and 1.5. But the general principle remains the same. A profitable trader can lose 70% of their trades and still make money. If their system has a positive expectancy, the key is to accept losses when they occur without being overly concerned about the win rate. The most important thing is to stick to a profitable system. If you enjoyed this video, please subscribe and leave me a like, leave and comment. I appreciate your support, and I'll see you in the next one. Bye for now.